Good afternoon, everyone, and welcome to SVA's four-part series on succession planning. In this series, we'll help you understand what a succession plan is, how to create a succession plan, and what your options are. We're also going to cover what potential buyers are looking for, as well as steps that you can take to help maximize the value of your company. At SVA, we've been helping business owners navigate these questions for years and helping them find the right succession strategy that matches their goals. Our hope is that this series gives you a clear starting point, but if not and you need additional guidance, we have a team of professionals who are ready to help. I'm Nancy Melberg, a principal at SVA, and I'll be facilitating today's webinar. If you have questions, please feel free to type them in the chat, and I'll do my best to answer them as we go. For more complex or specific questions, we'll follow up with you after the webinar. With that, I'd like to introduce our presenters today. Both are certified exit planners. We have Nikki Grolup, a principal at SVA, and Craig Maternowski, also a principal at SVA. They each bring years of experience in accounting, tax, exit planning, and strategic advisory work for clients. So with that, I am going to kick it off to Craig and let you take it over.
Thanks, Nancy. So what does exit planning really involve? Summed up in one sentence, exit planning combines plan, concept, effort, process to create a business that is transferable. So I thought, what are the most important words here? So I had those highlighted in yellow. So basically, it is a plan to build value in your company today to increase the sales price to allow you to sell it when you want to. All right. So what makes a non-transferable company? That is a company that relies too much on the business owner. So if in this example, be myself. So if I am the top salesman, I run every job, all the contacts and connections are mine, and I wear that with a badge of honor because I'm the hardest working guy there. How does that relate to value? And the answer is not very much. For a typical business owner, their business equates to 80% of their net worth. And if we look at the perfectly to scale Pac-Man model here, the yellow represents what the value of their business is. The non-colored portion is the value of their outside investments. So what does this tell me? Basically, that tells me that business owners are betting on themselves to win. They're all in with their blood, sweat, and tears to grow their business. So it makes sense that we work on the business to increase the value. 80% of a company's value can be tied to its intangibles. The other 20% is the tangibles, and that's going to be your fixed assets, maybe your inventory, and then the lion's share is going to be in the intangibles. So I call those the 4 C's. So the first C is human capital, and this is the strength of your staff and your management. Do you have long-term employees, or do you have high school kids that are there for the summer that are going to be gone tomorrow? Do you have strong management that is going to be able to handle the business when you're not there, or do they rely on you for every decision? So those two are going to have very different consequences to value. Next is structural capital. This is the strength of your processes, procedures, and strategy. So are your processes and procedures written down? Are they followed? Are they repeatable? Right? Can you open a shop across town and get it up and running with the same process fairly quickly? That means it's scalable, and that's going to be worth more than what something that is not. Customer capital. This is the strength of your relationship to your customers and suppliers. So do you have products that are repeat sales? This goes along with that model of you give away the razor and you sell the razor blades. So is it repeat sales, or is everything a one-time shot? Do you have concentrations with your customers? If you have your top 2 customers are 20 and 30% of your sales and you lose them, you're down 50%, you're in trouble. Same with your suppliers. Do you have good relationships with your suppliers? Do you have more than one? If you have only one that's in town and they go out of business, what happens next? That's risk. The final C is social capital, and this is the strength of your company's culture. Is your employees, are they buying into the culture that you're trying to build, or do you have a toxic workplace? Do you have strong brand recognition outside, or has nobody heard of your business? So all of these things together, if you work on it, can increase the value of your business. So basically, this slide says that you need to think of exit planning more as a process than an event. And this process sometimes can take 3 to 5 years in advance to plan for, and sometimes even 10. So your job now is to get your ducks in a row to build value in your company today. This is simply good business strategy. So the worst case scenario, if you do this, is that you build and grow the bottom line, and it increases income every year until you decide to sell, or maybe it's so good you decide, well, maybe I'm just going to keep it for a little bit longer. Okay, so what self-respecting discussion on exit planning would be complete without talking about EBITDA at least once? So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So if you look on the left-hand side, we have a sample income statement here, and it has just the normal sales and expenses. It comes to a net profit. And to that, we have the green letters that are the EBITDA that we're adding back, and we get a number. So that number we normalize or recast to get to a real number, and we'll go into that later on. This is just a high level view of that. And this basically is the starting point for valuations of the company. All right, let's look at some simple math and some numbers. We have three scenarios here. The first scenario is we have EBITDA of $500,000 times a multiple 5, and that gives us a company value of $2.5 million. Scenario 2 is we work on the business, we improve the EBITDA, so now that is $580,000. We take that same 5 multiple and we get a company value of $2.9 million. So we grew the company's value by $400,000 by simply growing the EBITDA number by 80,000. So scenario number 3 is we have that same EBITDA of 580, but now we work on the 4 C's, the intangibles, and we move our multiple from a 5 to a 7. We get closer to what's called a best in class scenario. And now we've increased the value of the company to $4 million, over $4 million. So we move that from 2.5 to 4 million, that's $1.5 million by simply working on the business. We can see the power of these multiples in EBITDA. So the multiple is determined by intangibles and tangibles in the company and readiness to sell, right? So we've said before that intangibles equate to 80% of the value of the company. So the stronger you are in this range, the higher the multiple, the higher we want to get to that best in the class, as opposed to if I was doing everything and I was at the worst of the class.
Good. So now we'll talk about like the big question of who are we going to sell to? What makes the most sense? So when I'm talking with a business owner and they say things to me such as, I've worked really hard to grow this company. I want to get the maximum value out of it. Then typically I would look at and I'd say, well, let's talk about and consider a third party sale. So within a third party sale, there's even different layers of that. So it could be a strategic buyer or it could be a financial buyer. In both of these scenarios, really you want the business to be able to stand on its own independently. So a strategic buyer, right? That's probably going to give you your highest multiple. Typically, I look at that and say, okay, they see synergies within your business that will make them pay more for your business because of how your business can help them. It might be that you have some intangible with know-how that they do not. Maybe you're in a geographic location that they aren't in. So instead of trying to build it, boots on the ground, build it up, they're able to buy your business and then instantly be in that marketplace. Also, within these third party sales, a lot of times it's cash at close versus rollover equity. It might be a combination of both, but you're more likely to get cash at close, especially for a retiring, somebody looking to go into retirement. Cash is king at that point. Others that are maybe don't need all the sales price for their retirement might look at, hey, maybe I want to roll some equity over if the new buyer would be okay with that, and then they can continue to participate in the business just from a different fashion. Some things to think about is integration risk, right? When you have a strategic buyer, are you going to be able to integrate into their established business or processes? And then the other thing to think about is for a financial buyer, such as like say a PE firm, are you going to have operational independence? So they don't want to just roll you into what they're doing. They want you to be able to stand alone as well. So if that's not the right option, or maybe you should explore all options. Internal transfers. So these are the best fit when you want continuity and legacy matters. So if you want things like, I want all my employees to have this a similar job, similar compensation, similar benefits. I hear that a lot. Um, I want I want this business to remain in the same location. I want it to remain with the same name. Some of those legacy type things, then you should consider an internal transfer. You do have to have you do have to have that internal person in there. So you really need a really strong leadership depth in order to consider an internal transfer. So some things to consider for internal transfers is usually it's longer timelines. You might need to do staged liquidity just based on this has been your employee. So they might not have the financial wherewithal to take it all at once. So maybe they need to take it over time and they need to continue to increase their compensation and use that compensation and the earnings from the business to allow them to buy more of the business. These transactions are heavily dependent on cash flow to support the debt. So essentially, the business needs to be able to support the debt load that it's going to be taken on because, these individuals have only had a salary before and may not have substantial amount of capital on the outside. And then the financing for these transactions, if they do get happen all at once. It may include seller financing. So you always want to have some equity on the table. So you need an internal buyer to come with something that might be some cash that they have, that might be some bank financing, that may be a mixture of all of it. But they need to have some skin in the game for it to be successful. Then it might also include some seller financing. So you need to consider, does that work out with your estate plan? Also, you need to consider what if this doesn't work out for this individual in this business? Are you ready to step back in? Because you're going to get paid after the bank gets paid. And then another item to consider is typically I don't always look to internal transfers if somebody's telling me, hey, I want the maximum price that I can get. So sometimes these might be lower sales because you don't have that premium value that a strategic buyer would pay. And then if you maybe have family members working in the business that are interested in taking over, you might consider a family succession. We've all read that, generational businesses become less and less likely to succeed as, you get into the multiple generations. One thing to consider there is the governance structure. So it's pretty much a guarantee that if you have a strong governance structure when you're going into a multi-generational business, if you have a board, if you had advisory boards, those are really the differentiators between success and failure. So whenever I'm working on family succession, that's one of the first things that we'll talk about is what is this going to look like during this transaction for success. Also, estate and gift planning intersects heavily here. So you have the business owner leaving, you have, maybe a child, kids that are going to take over. A lot of times you look at estate planning and how does this work into your estate? And a lot of times in these situations, we aren't trying to get the highest value. Sometimes we're just trying to get, hey, what's the fair value of this transaction? Or sometimes there's a component of a payment and a gift, and sometimes it's all gift. So it's really, working with the family to understand what are your objectives and what are best in these situations. If you have a really strong company with a really strong management team, and you have stable cash flows, you're just financially just really strong and maintaining, you might consider an ESOP. So these are, you would look at it for when you want to prioritize employee continuity and also tax efficiency. So these do work best for low growth, more stable environments. And one item to consider here is the purchase liability is often underestimated in these. So you really need to work with an advisor to understand what is that repurchase liability? What do we need to book? What do we need to plan for as far as cash flow goes? But there are significant tax efficiencies with this option. And then partial exits and recapitalization. This is actually an area that that is really prevalent right now. And this might be a business owner that has grown a really substantially large, well-off business, and they're looking to de-risk their ownership, right? So, like Craig said, you might have 80% of your net worth in the business, so that's pretty substantial. So this helps you get some cash out of the business. Excuse me. This helps you get some cash out of the business without selling everything. So you can sell a minority or a majority. Um, and then this is likely a first exit. So oftentimes there's a sale later. You really want to understand your partner selection. You don't want to bring in a minority partner that you can't work well with. Likewise, if you're bringing in a majority partner, right, they're going to have some decision making based on your operating agreement. So you need to take that into consideration. And you need to make sure that there's alignment with this new partner on growth strategy and exit, because ultimately, if there is an alignment, it's not going to be successful.
All right, personal, financial, and business considerations. So I like to think of this as two concurrent paths and they're going on at the same time. So the first path is the personal financial path, and the second one is the business path. And again, both of these need to happen at the same time. Both paths require a strong team behind you, and this is a typical team that you would need: a CPA, an attorney, a financial planner, and a business broker. Again, the business broker will be potentially. There are others, but these are the main players in this. All right, so it's best practice to get a financial planner advisor in this process the early as possible. And so what they can do is they can take a look at your portfolio and what it is going to be after the sale and manage towards allocations of stocks and bonds, foreign investments, growth value, dividend stocks, look at rate of returns and play that into the big picture, right? And so oftentimes they'll run as what's called a Monte Carlo simulation. And what that does is they throw in different variables of if this, if that, how does this affect my portfolio and my retirement? And it's very helpful in figuring out how much that you need to retire. So they look at your risk tolerance, they manage for risk, and they do estate planning as well. So if you're playing at home and you want to figure out how much do I need for retirement, right? So you can do this by doing this simple rule of 25. And that is first step would be to figure out how much do I need to retire on an annual basis? And then I multiply that by 25. So in our example here, I need $400,000 a year to retire times 25 equals $10 million. All right, the next step is to determine what your wealth gap is, and some people call this the asset gap. And so the first step is to figure out what our wealth goal is, and we saw that in that previous slide, and that was $10 million. So to that, we subtract out our assets that are held outside of our business. In this example, it's 2 million. So that gives us a wealth gap of $8 million. So basically that $8 million is how much I need to get for the sale of my business to live the lifestyle that I want to. So the next step is that realistic? Is that reasonable that I can get $8 million for my business? If not, maybe we have to rethink our lifestyle in retirement. So maybe instead of traveling the world, I have to downsize that to traveling Wisconsin. Maybe instead of retiring in 2 years, I have to rethink that and make that 6 years and work on my business to increase the value until then. Maybe that means I sell the operations, but I keep the building and continue to rent to the new owners for a while until they're ready to buy that or until I'm ready to sell that. or it may determine who I sell the business to. So we determined before that Nikki said that if we sell to a strategic buyer, I can get more money than if I sell my business to my kids at a bargain basement sale price, right? Or finally, it can determine whether I sell part of it now and take a bite of the apple and later on sell it fully on a second sale. And that could be either to my kids, or maybe that partial sale in the beginning is to private equity and they inject some knowledge in the business and they increase the value and that gets me a higher price on that second sale. All right, now this is an often overlooked thing. And what this basically says is when you retire, it's important to have a plan and a vision on what you're going to do after retirement, whether that be vacationing or volunteer work. You have to have some sort of purpose. So I think you're used to going to work early, staying late, making important decisions, being a big man on campus, and all of a sudden tomorrow you're not, right? So what's going to fill that need and that purpose for you? About the worst thing you could do is not have the plan, and you have a spouse that's maybe retired a couple years before you, and then they have their routine, and then you come in without a routine, and that just creates some conflict at home. All right. So this is the business path. And again, this goes on at the same time as that personal financial path. And we went through a lot of this before. So again, to rehash, 80% of the net worth of a typical business owner is tied into their company. We should create a plan, a 3 to 5 year plan to build value and growth. The first step is to de-risk the company. The second step is to build value. If we do all of these things, the first 4 steps, we're going to improve the EBITDA. If we work on our 4 C's, the intangibles, we'll improve our multiple. And we saw what the power of math is with a couple slides back.
Good. So now we're going to talk about, are we ready? How do we assess if we're ready? What does that look like? So is the business ready is the first area that we'll talk about. So we really wanted to focus on some red flags here so you can start to equate this to your business and see, hey, do I have any of these red flags? If so, this is the number, this is the area that you should start looking on. Like Craig talks about, getting rid of red flags are going to increase your multiple, increase your purchase price. So one is owner dependence. So if I think Craig also referred to it as, I'm in the big man in the shop. Well, if you are the big man in the shop and the person can't, if the business doesn't really make decisions while you're gone, that's problematic, actually. If you're the only rainmaker in the business, if it creates bottlenecks when you're gone, those are all problematic, and that's going to decrease the value of your business and create less buyers. Financial quality. So if you only have cash basis financial statements, if your margins are inconsistent, you have heavy add backs, that's also going to decrease the value of your company. Through the sales process, there's something called due diligence, and due diligence will go and it'll look at all your in that process, it will look at all your financial statements. There might be a quality of earnings report, for instance, study done. And all of these, if your financial quality is not pristine, it's going to cause you problems. So it's either the buyer could just step away and say, this business isn't ready, ready for a transaction. The other thing that could happen is, while they might have given you a letter of intent, hey, we intend to buy at this thing, they might have been relying on incorrect information that they found when they got into your financial statements. So they might reduce the amount that they're going to pay, or they, might have more of an earnout on the back end or other structures that are less advantageous to you. Customer concentration. So let's say your top 1 to 3 customers drive a disproportionate amount of your revenue, is pretty problematic with businesses because of that risk. So what that means to you is, a lot of times with businesses with high customer concentrations, there's going to be a big earnout on the back end instead of upfront sales price because they want to make sure that they maintain those customers and maintain that revenue. So while customer concentration, sometimes I have businesses that say, well, should I not be doing work for those customers? Well, no, because then that decreases your sales and then that decreases your price too. Is you just should look at, hey, can I diversify my revenue through additional customers or additional services to different customers as well? Would be very important to de-risk the business. Management depth. So if you, a lot of times when we look at owner dependence up above, we want to really move that down to a next layer of management. Well, if you don't have that next layer of management that you trust and has the ability to make decisions, that can also be a problem too. So you really need to make sure that you're staffed appropriately for the size of your business. And then red systems and reporting. So lack of timely, hey, I only reconcile my financial statements quarterly, for instance. I don't really have that reliable of KPIs that I'm using to run the business. Those are all lead to a business that is not stable and necessarily ready for a sale at maximum price. So then we want to look at financial readiness at the owner level. So typically when we go into a transaction, we'll look at net proceeds after tax, fees, and debt payoff. So how much cash are you as an owner going to get that you can then equate to your personal financial plan and estate planning? This is also then compared to lifestyle needs, wealth transfer goals, risk tolerance post exit. Hey, do I want to say I'm going to live to age 75 or do I want to say I'm going to live to 105 and not have any risk of running out of money? One of the common issues here is that owners anchor to enterprise value and not net proceeds. So enterprise value is, hey, this is how much a willing buyer is going to pay for your business, but then it doesn't take into consideration, hey, okay, then you need to pay tax, right? And we'll minimize that tax, but it's definitely going to be there. There's going to be fees, right? For the engagement. And then you also need to pay off your debt and other liabilities. So, what does that working capital look like? So, what inevitably you have to get back to what is your net proceeds after all of those expenses. And then personal readiness, which Craig touched on. So I'm thinking about personal readiness, typically in a transaction. The buyer might be looking for you as the business owner to stay on for a period of time to help them transition the business. Uh, and that's all negotiable. So you need to, before you get into a transaction, understand what is my personal willingness to stay on, what's that time frame look like, and what does that mean to me? So then you can really stay true to your objectives. Identity shift. So you're going to go from an operator to an investor. That's really hard. So what information are you going to need if you have equity that you left in the business? So if you're switching from an operator to investor, somebody else is making those decisions. What do you need? What kind of information are you going to get as an investor? And what information do you need to understand that investment, but understand that you're not going to be in day-to-day operations or in the decision-making process. Or you're going to just totally transfer from, hey, I'm working one day. Maybe I had a period where I stayed on for a short period of time, and then now I'm retired. And what does that look like? The most successful transactions, my clients have understood what they were going to do post-transaction, which really made it smoothly. They weren't confusing or getting worried, or sometimes if the individual doesn't know what they're going to do post-transaction, the transaction might get delayed or stalled because of that. And then understand the time horizon. So we talked about, a third party sale might be the fastest. Maybe that's what you want. Maybe it's like, no, I want a phase transition. I want to do this over time. Well, maybe an internal transaction makes more sense for you. So really understanding that it's not one size fits all. Every single transaction, every single business is unique. So it's really tailoring, well, what meets your specific and individual needs. So now that we talked about, are you ready? How do you tell is my specific business ready? So I recommend an assessment framework. So this is There's some really complex ones out there. This is as simple as it gets, but on a scale of 1 to 5 across key categories, look at what is my management depth? What is my customer concentration? What is my financial reporting quality? What is the owner dependence? And then based on that ranking scale, you can start to say, okay, do I have red flags? Understanding that those red flags will probably lower my purchase price. And then you can start working on them. Like you can make meaningful change here. You just need enough time. You just need that roadmap, and you need to prioritize what makes most sense for your business. So, like for instance, if we have a low management depth, that might mean our multiple is going to come down. And Craig showed us before, like that can be pretty significant in a sales price. If we have high customer concentration, there might be an earnout or there might be escrow pressure, right? We might have to leave some of the transaction in escrow until meet certain requirements. If we have weak financials, we might have diligence risk, right? And maybe we don't get through due diligence. Maybe the sale doesn't go on, or maybe it doesn't, inevitably, it's not at the same terms as the letter of intent. And then let's talk about timing. So the optimal timing is influenced by both internal, so your individual and the business readiness, and external conditions. You can control one thing and one thing only on here, and it's your internal readiness. So you really need to focus on that so you're ready when the market's ready. So you really need to make sure that, hey, I've looked at all these areas, I've looked at the growth trajectory. Now you've got the business ready for due diligence because on an external factor, interest, things that affect, when the right time from an external market to sell might be interest rate, right? We've been through some volatile times with interest rates, and that's very meaningful to what an individual will pay for a business. Private equity dry powder levels. So how much equity is there out there to purchase businesses? Industry consolidation cycles. So as we see PE firms really consolidating certain industries, and those are typically done at a really high value. And you want to be ready, you want your business to be ready that when the external, when these opportunities arise, that you're ready to sell. So just remember that you can't control the external, but you can control the internal. So this is all really important to be thinking about. And then 3 truths about exit. So most owners are not as ready as they think to sell. Oftentimes we'll be working with businesses who think they're ready, and then once they get into it, they realize, okay, there's a lot more that we could do. Value gaps are usually fixable. So we talked about, hey, do I have enough to retire? Yes. If you don't, like you can do things about this. There are meaningful ways to increase your financials and increase those multiples. And then the best time to prepare is before you need to exit. So you don't want to be in a position where you have to exit and you haven't prepared.
Thank you, Nikki and Craig. That was great information. I think the key takeaways from all this is that no succession plan is going to be the same. It's going to depend on your objectives. And there's a lot of different options. We have worked to customize a lot of them specific to companies. So keep that in mind. In the interest of time, because we're already a couple minutes over, we don't really have any um, availability to answer any questions live, but we would love to answer any of the questions anyone has. So please reach out to us, any of us, with your questions, and we will get those out to you right away, those answers. And I did want to just mention one thing. Nikki talked about an assessment in one of her last slides, a risk assessment. We actually do have a program that we work with that if you email me, I can get you a link to answer a questionnaire, and it will come back and it will actually give you a score and tell you your weaknesses and where you need to start to focus on to improve that value. So just reach out to me if you'd like to take that assessment. And then I'd like to welcome you to our next three succession planning webinars. We have one coming up May 19th, then June 16th, and July 22nd. And each of these will dive a little bit deeper into some of the topics we talked about today. And I believe there is a link for you to go in and log on or register for that, each of those webinars. So again, thank you everyone for attending. We hope that you got a little bit of value out of this. And if there's anything anyone needs, please reach out to us. Thanks again. Have a great day, everyone.